going to happen.
We have no script. Hey, welcome everyone. Matt and I were just talking about we have no script, but we want to talk about mortgage rates, especially today. Thank you so much for joining us. I have Matt, the mortgage guy. If you guys are not aware, I got posted on YouTube saying the average rates right now for people with exceptional credit, according to the Mortgage News Daily, as of today, is 7.08%, as you guys saw in the thumbnail here. So absolutely insane. I want to talk about why mortgage rates have increased so much and also impacts for home buyers right now. But yeah, I want to welcome Matt to the channel. So thanks for joining us.
Yeah, thanks for having me, Jason. I think like we talked about last time, there's no shortage of news in the housing market. There's no shortage of action and volatility with mortgage rates, with housing prices, and with all of it. So it's nice to come on here, have a good conversation, and then, answer some questions from people across the country and get a little insight into what they're seeing, hearing, and feeling in their markets.
Yeah, I mean, what a dynamic shift in our housing market. I mean, for like new home builds, for example, 1 year ago, you get on a waiting list if you're lucky. And then if you're lucky, they would select you, and then you put a deposit down and the house is not built for like a year. And now I have builders reaching out saying, hey, we have completed houses or houses that are really close to being completed. And do you have any buyers who are interested? We have a lot of concessions. Like one builder said they have like $50,000 in concessions they're giving home buyers right now. So what a dynamic shift in our housing market, especially where you're already new home builds. Yeah. All right. So one thing I want to talk about, we already have almost 100 people here. It's awesome. Thank you so much for joining, everyone. So one thing I want to talk about, which is absolutely nuts, how does this impact current home buyers right now? So I actually did some numbers for you guys. You guys all know I'm a data nerd. Looking at numbers, the median sold price, or actually the median asking price, according to Redfin. Actually, what if I just share my screen? It may be easier to do that. Let's see, window. Come down. Let's see. Does that work?
That works.
You can see my screen?
Yep.
You can.
Holy moly. Look at that. Look at that. That's a steep ramp right there when you show the 30-year fixed on
well, this is the median list price. So looking at list price according to Redfin right here, right now it's 381,000. 1 year ago it's 351,000. But yeah, looking at this like giant increase that you were talking about right there, Matt.
Yeah, that was the ramp.
Absolutely
that's
insane.
A steep ramp.
Yeah, that's like a steep hill to climb right there. On January, rates were around 3.3%. Can't quite get there, but yeah, around 3.3%. Now they're 7.08%. Look at 15-year, 6.33%. I have a buddy who has a 2.25% 15-year. So absolutely insane. I mean, look at all these rates, absolutely crazy. And so what I looked at is like, okay, well, home buyers right now, compared to 1 year ago, I talk about this pretty frequently on the channel. Looking at a median asking price 1 year ago at 351,000, putting 20% down. Your rate 1 year ago would be 3.14%. So your P&I payment, principal and interest, would be $1,205 per month. But fast forward right now, median asking price $381,000, assuming a 20% down payment again at 7.0%, at 7.08% is just over $2,000 a month, which is absolutely insane by my dumb math right here. That's a $839 increase per month compared to 1 year ago, or a 70% increase in your average monthly mortgage payment compared to 1 year ago. Absolutely nuts. So I wanted to share that with you guys because that's directly impacting home buyers right now looking to buy a house. Hey, Kevin, good to see you from Lakeland, Florida. Anyways, yeah, I want to talk about how it's going to be impacting home buyers right now and why are rates increasing so much. So one thing, a question I have regarding this, Matt, is last time the Fed met, they increased the federal funds rate by 75 basis points. They did it again this time, but last time mortgage rates decreased quite a bit. We went from 6.3 down to 5.05% as of August 1st. And this time it's totally different. Rates are absolutely skyrocketing, up almost 2 percentage points since August 1st of this year when rates were at 5.05%. So totally nuts. What's going on?
Yeah. So I think that that's something that's important to take into consideration is by the time the Fed has a meeting and takes any action, that seed has been planted long ago. And so the market is essentially baked in what's going to happen well before the rates moved. And what happened this time, which contributed to, what has been a really volatile and really bad week for interest rates, is that the Fed not only talked about their future plans to hike rates and keep rates high for a longer period of time, but they do what's called a dot plot, where every member of the Fed kind of shows you over the next 12 or 18 months what the plans are,
for the rate. Yeah. For Fed fund rate.
For the Fed funds rate, what their target rate is. And, between Jerome Powell, getting a little bit more serious in his tone of like, they're going to do anything to quell inflation. He used words like, pain in the market.
Bring the pain. Yeah.
Bring the pain. And, so he's talking about this and actually taking action where the market, really over this last week, we've seen a dramatic increase in interest rates, and it's probably not over. We probably see interest rates continue to increase. We're going to have to see continued downward, inflation. We're going to have to see inflation come down before the Fed lets off of the gas pedal, which is, tightening monetary policy. And I think that on that note, what was I going to say? I lost my train of thought. You can talk about Eric. I like that UFC pick he's got there. That's cool.
Yeah. Sorry to me to throw that in. I thought it looked like it was going to expire here. So yeah, Eric, I don't know anything about Butte County unless Matt does. And Paradise, gosh, everyone knows about Paradise with the fires there a few years ago. But what percentage of a correction do you think we'll see? I mean, it's anyone's guess. I'm not familiar with Butte County whatsoever. And whether you're talking about Butte County or Sacramento County, it's really hard to gauge how much of a correction we're going to be having because it's impacted by rates, which can fluctuate, as we can see, greatly on a weekly basis, and also inventory as well. Some areas are seeing a huge increase of inventory, others are not. So yeah, it's really hard to forecast what's going to be happening.
Yeah, that's the thing too, is like, it's all area specific, but just like I wouldn't be able to predict what rates are going to be in March 2023. 1,000 different things can impact what happens to rates, and then rates impacts, demand. And we don't know, what inventory is going to do over the next 6 or 12 months, because we're still yet to see what an impact, these low interest rates, 2020 and 2021. I think there's a lot of conversation around that. People are really disincentivized to sell. Even if they're moving and buying something new, if they've got a 2.5% interest rate and you look at what rents have done, you start to reconsider, what, I've got a $2,100 mortgage. That's a pretty sweet mortgage because that 2.5% rate. If I can rent this thing for $2,800, maybe I keep it. And that's happening a lot because I'm having those conversations every single day. That's one less unit that gets put on the market. So it puts further constraint on the supply side.
Yeah, for sure. I ran some numbers for myself and I thought, okay, well, if I were to do basically like a level, or what do you call it? A flat move where I'm basically buying the same house as I have right now, because rates have increased so much, my housing payment would more than double if I basically bought the same price home I have right now and buying another one. Or if I was going to be moving up, buying a bigger house, for example, my housing payment would go up like 60 to 70%. And so, why would I sell my house right now, looking at those circumstances? And also, like you alluded to, because rents are so high right now, if I were to rent a similar size house in a similar neighborhood, my rent would be way higher than my mortgage payment. So it really doesn't give a lot of people motivation to sell, given the fact they have such low mortgage rates right now, or locked in mortgage rates. But going back to your statement before I interrupt you, regarding the Fed. And so basically this run up in mortgage rates we're seeing right now, you're saying is more tied directly to that the fact that the Fed wants to combat inflation more so than they initially alluded to. Is that what you're saying? So we're basically going to be more aggressive on raising rates in order to combat inflation.
Yeah.
Is that what you're
Yeah,
saying?
and I mean, they basically say at any cost. They don't care, what it does to the economy, and
For some reason, I'm having a hard time hearing you. You have some static for some reason. I don't know if anyone else can hear that. Probably not.
I'm gonna test something.
Is the audio okay for everyone listening?
Let me know, because I think. Hold on, stand by.
I don't know if anyone can hear the static noise. Matt will figure it out. Matt's audio is bad. I thought I could. Matt is breaking up. So yeah.
Mic check, mic check.
Try it again.
Is it better on your side?
No, it's breaking up a little bit, like staticky noise.
That is so weird.
Ryan Lundquist says, "Come on, Matt, get it together." Hey, Ryan. Ryan's an appraiser here in Sacramento. Try again.
Ryan, you know anything about tech, Mr. Lundquist? You come help me out. Come by and check out my my equipment over here.
Maybe you can exit and come back in or something like that.
Okay, I'll try that, because I don't know.
Check your
what it is.
Let me can I remove you and put it back on? Let's see. He'll hop back on. Anyways, I wonder if you guys saw the new report regarding new home construction, home sales. Sounds good now. Well, he's gone now. Let me see if there's any questions. Actually, let me go to that, because I know I haven't seen any of your questions here. Yeah, I mean, rates have shot up greatly. It's so crazy to see how much it's gone up. It's so crazy. Here's Matt. No. All right. Yeah, I don't know a whole lot about Reno, Nevada as far as the market goes there. Jacksonville, Florida, make a separate video regarding that maybe 3 weeks ago. So check out the channel for that if you missed that. But yeah, Reno, Nevada, I don't know a whole lot about that. I actually haven't done a whole lot of research regarding that. Let's see. Any guesses on when the real estate market will actually bottom out? Bottom out. That's a big term right there. Bottom out. 1 year, 2 year, it's anyone's guess. So the really challenging part about predicting our housing market, honestly, is that there's so many things that affect our housing market that are completely out of our control. Like mortgage rates. I mean, who would have forecasted mortgage rates to be 7% at the end of September when we're at 3% January 1st? So there's that. Plus, how many people are going to be listing their houses for sale? I've been making a bunch of videos saying how the number of new listings have been going down greatly ever since like past 3 months, and that's causing actually a decrease and also some stagnation regarding inventory growth. We're not seeing inventory increase like it once did. So there's a lot of things that factor into our housing market that it's impossible to predict. And so to say when the market's going to be bottoming out, I mean, we're kind of at the beginning stages of a housing market correction here. And so it's really anyone's guess when it's actually going to bottom out and then go back up. I would say, generally speaking, when rates start to decrease again, potentially that could be the beginning of a bottoming out, but we have a long ways to go, I think, especially if the Fed actually does bring the pain. We'll see. Let me move this down a little bit. All right. What else do we have here? Kevin, good to see you. Thanks for joining in. Looks like Matt's back. Are people's credit scores today held to the same stringent standards they did 20 years ago? All right, Matt, can we hear you?
Microphone check. 1 2 1 2.
There you go. Perfect.
Oh,
so you went to Amazon and ordered one. It already got delivered. That's awesome.
I'll tell you what. This is a little tech hint for everybody. What you want to do is you want to unplug everything and plug everything back in and retry. That's the extent.
Who would ever guess that? Ben had a good question. I'm just answering questions since you're MIA and you're back. I mean, last time I'll ask you to join me on my channel. That's for sure. Oh man, this is what happens when you have live videos. There are 350 people here who just watch you try to figure out your microphone.
I mean, that's what people are here for. They're here for real life. They want. I mean, that's why I'm Matt, the mortgage guy. There's no professional stuff you name. They just want, person they can relate to, going through the same struggles they are, trying to figure out how to, fit a payment they can afford into their budget. That's what we're doing all day, every day.
Yeah. So one thing I'll add is that your mic is awesome, but now your picture of yourself is totally fuzzy. So you might want to autofocus on your face, maybe.
So weird. When I look at my StreamYard, you look fuzzy and I look clear.
Really? What do you guys think in the comments below? I don't know. I see him as totally fuzzy. What do you guys see?
God, this is a good representation of the housing market right now. Mortgage is going crazy.
It's
Real
unpredictable.
estate's gone crazy. It's unpredictable. Yeah, see, entertainment. People love this stuff, Jason.
Yeah. He
fuzzy. Which he?
So, well, yeah, I guess Jason. Now is good. Both of you are fuzzy? Really? Now you look better, actually. Very low bandwidth. I don't know. I have good internet access here. I don't know. We'll try. Let's just roll with it.
8-bit Matt.
8-bit Matt. Okay. All right. Let's get to Benjamin's question here. He says, are people's credit scores today held in the same stringent standards as they did 20 years ago? Maybe you can take that one, Matt.
I mean, if we're comparing to 20 years
Fed
ago,
has lowered our bandwidth, by the way. Sorry. That's good.
The Fed is
Thanks,
raising rates and lowering bandwidth. Yeah, we've got
all right. All right. So going back to his question, let me find it again. Sorry. I just saw that.
I mean, credit standards are likely tighter than they have been, right? They continued to loosen through the early 2000s until everybody saw what happened 05, 6, 7, 8, where it was just a disaster. 10, 11, 12, they were as strict as they've ever been because, that was a time when we started putting a bunch of stuff in place to avoid all the disaster and mess before that. And I think that, for the last decade, for the most part, there's been some ebbs and some flows, and there were some extra layers put in during COVID that have since come off. But if you're asking in general, like, I would say that, lending hasn't changed a ton in the last decade, as far as like, you've got to qualify for a mortgage that you're getting. And obviously there's all kinds of programs that exist with debt service coverage ratio and bank statement loans, but I'm talking about conventional loans and then government stuff like FHA, VA, and USDA. I think they're held to the same standards. I guess, if we dug into that question, there's some things like medical collections that don't hold as much weight. And that's something that the credit agencies have corrected, just because there's so much, bogus medical collections out there. But as far as lending is concerned, right? Like FHA will go down to a 500 score if you put 10% down. If you put 3.5% down, they'll go down to a 580. Conventional lenders usually want you to have 620 plus. And, based on where that score lands, 780 is going to get you better terms because it's deemed as less risky than if you've got a 640 score. So hopefully that answered it. Hopefully that provided some clarity, Benjamin.
Yeah, I mean, I think the credit availability has gone down greatly compared to 06 to 08. I mean, the amount of credit available to people has gone down greatly, and that shows that the underwriting standards is more tightened right now. And then to get the best rate too, by the way, you need like approximately 740.
Yeah, 740 plus. And then if you're, doing a jumbo loan, some of those lenders will even bucket 740, 760, 780, even 800 plus. But it'll be pretty small increments of how much better it gets. If you've got 740 plus, you're generally going to be in the top tier.
Got it.
One quick little add-on to that, Jason, is
yes, sir.
When it comes to qualifying, I've been thinking about this a lot lately, where come across clients that might not qualify. I think that if it's viewed the right way, is a blessing in some ways. A lender is just
what's
saying
a blessing?
To not qualify, and for a lender to say, it's not a no indefinitely, it's just a not right now, based on what your income is, what your current debts are, and your credit score, and all the things factored in, you don't qualify. People get upset. Oh man, I'm so mad I don't qualify for a $500,000 purchase. Well, based on what your income is at this moment and what your debt load is, it's not, it's not smart for somebody to set you in a $3,300 a month mortgage payment, right? And so I think that people view that as, they're upset about it. And as much as I'd like to qualify everybody, some folks just, it's not the right time. So anyhow, just a little 2 cents.
Thank you, sir. Well, do you have any thoughts about this gentleman's question here? Will rates drop lower, 12 months, 18 months, locked on an ARM at 6.375, hopes to refinance later? My question for him or her, it's hard to tell, is, how many years do you have fixed? Is it a 10-year fix, 5-year fix? Because if you're looking to refi and you have like I don't know, can you even get like a 3-year ARM? I don't know if you can do that anymore.
They're not very
5 is
common.
kind of minimal,
Most of them are 5, 7, 10. Yeah. And I guess my answer to Tej, is when inflation comes down, it's likely that's when we see rate relief. The Fed has made it very clear they're going to continue to raise the Fed funds rate, which in turn is going to affect mortgage interest rates, and they're going to do it as high, as long as needed to get inflation under control. If we see a bunch of inflation readings, which I think we will, October, November, December, where that core inflation rate comes down, there's a chance we see some rate relief. I think that immediate, 3 to 6 month window, very, very unlikely. In the next 9 to 12, I think we do see lower interest rates. It's not guaranteed. And, every day I've got to remind myself and my team and anybody I'm talking to that nothing's guaranteed. There can always be, other factors that we don't even think about right now, or stuff that's not even on our radar right now that's going to come into play and cause interest rates to go to 8.25. But I think that, the current levels, 7 and 7.5 is probably going to be the peak. And when inflation's under control and Fed starts, backing down or U-turning from this real, tightening cycle, then we'll see interest rates come back down, which is going to be good for buyers who need some, relief in terms of affordability.
Yeah, I mean, whether you're the rise in rates, we're seeing these decreases in prices, which is obviously good for buyers as well. But we're not seeing huge decreases just yet. Benjamin Miller, the mortgage rate run up yesterday was wild as we went under contract yesterday morning. Original quote on Saturday at 6.25% for a 30-year fix. Disappeared quickly, and the buy down rates would have been wild. Yeah, I mean, it's absolutely insane to see the run up in rates. I mean, they went from 5.05% on August 1st. Now we're at 7.08%. I mean, that's just totally nuts.
Yeah, 2% in less than 8 weeks, and
yeah.
Yesterday was a really ugly day in terms of how many basis points we lost. It was like 155, which in layman's terms is 1.5. So whatever Benjamin might have seen on Friday or Saturday for that 6.25, if it was a $500,000 loan amount and it was 1.5 worse on Monday, that same rate cost him another $7,500 in one day for that $500,000.
$7,500 for the year, or what do you mean?
No, I'm talking about like
for buying points.
Yeah, on Monday.
Oh, okay.
Like if you looked at the same rate on Friday and Monday, and you lost 1.5, then a $500,000 loan would see a $7,500 increase for the same rate. So that's drastic.
It is drastic. I mean, it really affects people who are looking to buy like a medium price home in America right now. I mean, how many people can go from a $2,000 or like $1,200 per month payment up to $2,000 a month in just 1 year? It's just totally crazy. One person asked me a question once, and I didn't know the answer to this. Maybe with this run up in price and run up in rates, we're going to be seeing a lot of people who are buying down the rates. We're seeing builders offering that as an incentive to entice them to buy a brand new home. But how much can you actually lower your mortgage payment by, or not mortgage payment, your mortgage rate? Because you can't go from 7% down to a 2% rate. So what's the Is there a general rule of thumb of how much you can lower your rate?
Yeah, and that's something that has come up a lot lately because people are like, oh my gosh. The good news is they're getting seller concessions. They got sellers that are willing to negotiate, and they can get those credits. But then they're like, what do I need to pay to get down to a 3.99? Or what do I need to get to a 4.5? Right now, if I look at, great credit, $500,000 purchase, 10% down. If you're buying a primary residence, your max seller credit available is 3%.
3% of the purchase price.
Right. On a conventional loan. On FHA, you can go 6%. A lot of people don't know that when you buy an investment property, you can only get 2% in seller credit. That's the max. And so I'm seeing some situations where people are in contract with stuff that doesn't even, you can't even use it. But let's say for you're
saying that's the maximum credit. Just to back up a little bit. So you're saying that 3% of the purchase price is the maximum amount that a buyer, is that you're talking about total or to pay the buy for points?
Right. And actually, you know what?
God, you're talking about only points. All right.
Yeah. I had some notes too, because I think with a larger down payment, you can get bigger credit. Gosh, I should pull up those.
Okay. Well, general rule of thumb. So you have like a $500,000 purchase, the maximum you can buy down is $15,000. And it depends on how much of a
well, and that's the thing too, is like you have to pass QM to have a qualified mortgage. Just for example, because people probably, examples are going to work better than throwing a bunch of numbers at you. If you're buying a $500,000 house and you're putting 10% down, to get to about 5,875 is 3 points in cost. And I'm saying that, like, even though the lender's rate sheet might show stuff in the 4s, you can't pay 8 discount points. It's not allowed. The loan won't pass QM and you won't be able to fund the loan. So,
for everyone who's watching, you mean QM, you mean underwriting. Is that what you mean?
Right. Yeah. Yeah. It's basically, qualified mortgage and it's got to pass that to be able to fund the loan. So, for all intents and purposes, you're not going to be able to, no matter what you do, get a rate on a 30-year fixed loan much lower than 5.75, 5.875 currently. Who knows? We might see some rebound next couple of days.
Yeah, and Antara says I thought 4.75 was too high a few months ago. I mean, seriously, we've been so used to having rates around 3% for the middle of 2020 all the way until the end of 2021.
And that's an interesting thing to bring up because when we saw rates go to 6, and then like you talked about August 5th was when we came back down. A lot of lenders on the wholesale side sub 5%. 4.875, 4.99, that like first week of August, it was a small window. It was crazy what that did to buyer sentiment, because I saw, if I look back at applications, a lot more applications those first couple weeks of August, because people were like, that 4.875 looked really good once people got exposed to 6s. It didn't look good for the people who were shopping in 3 months before, and they saw stuff in the 3s and 4s. But I think I was talking to somebody about this recently too. Once we do see some rate relief and rates come down, people are going to see something like a 5.25. They're going to be ecstatic about it, right? Because they've been exposed to these higher rates, and they've really seen like, holy moly, this is quite an impact on the monthly payment.
For sure. I mean, I'll share my screen again. I actually made a video today that kind of touched on that. Share my screen. All right. So take a look at this. You guys can see it, or you can see it, Matt?
Yeah, it's a little small, but I can.
It's a little small. Boom. All right. I can fix that. So this is according to the U.S. Census Bureau. I just announced this morning. I made a video. It's going to go live tomorrow morning or maybe tomorrow afternoon. Look at that. So this is August. These are for this is for new houses that are single family. So not multifamily, only a single family houses. Increase in home sales there by 28.8% in August compared to July 2022. So we saw almost a 29% increase in the number of home sales for newly built single family houses in August. And this is due to the fact that what is Matt's talking about, where rates decrease quite a bit. They decreased from what 5.05%, and they went from what 5.7% ish for the first 3 weeks. So rates decreased from about 6.3% in mid-June and came down quite a bit in August, and that's why it caused the increase in home sales for newly built houses. And the Census Bureau defines a new home sale as when a contract is signed. So it really acts like a pending home sale. So interesting to see what you're mentioned there, and we're seeing that on a national level as well for new home sales. Stay tuned tomorrow for that video, by the way.
Hey, let me clarify this too, because I didn't. Yeah. Now I've got my seller credits video notes. I mean, I literally made the video a month ago and already left my brain. Up to 10% down on a conventional loan, you can get 3% in seller credit. If you put 10 to 25% down, you can get 6%. Put 25% or more down, you could get 9%. I have no idea what you do with that 9% credit. It would be too much.
9% credit or a lender credit?
Well, from the seller. That's the max seller credit. But I'm telling you right now that like between the 3 points that is maximum for passing QM and probably 2 to 3% total in closing costs, you couldn't find a way to spend the 9. So it's kind of irrelevant, right? 6% is kind of the max number where you use half of it for buy down and the other half for closing costs and prepaid escrows.
Right. I mean, I can't imagine a $500,000 house and you have like $45,000 in that credit. Like, doesn't make any sense whatsoever. Huh. All right. Yeah, I mean, this is such a hard squasher. Squirrel squasher. I love it. When would I buy? Plan to buy? I plan to rent. Yeah, it's when to buy is like such a personal decision. It's so hard to know.
When should I buy a Tesla stock?
Yeah, it's like there's so many factors involved. It's really hard to say. Summary for first-time home buyers in Sacramento Market. Lots of price drops and thinking wanting to sell. Yeah. So in Sacramento, I haven't made a video about Sacramento in a while. Maybe I should do that. But around like 50% of the houses listed for sale in Sacramento have had price reductions. So we're seeing some softening in our market for sure. We have a lot more houses for sale compared to a year ago. And so just as like a side note, like buyers right now have a lot more power. They have a lot more negotiating power right now compared to 1 year ago, even compared to the spring. And so buyers right now are getting concessions from sellers. They're getting houses for less than asking price and not having to waive your appraisal and your loan contingencies and name your first child after the seller. I mean, it's just like a totally different market now, even compared to the spring of this year. And this is pretty common for the nation as a whole. But yeah, Matt is on the loan side. What are you seeing? Because you look at contracts probably pretty frequently. What are you seeing in the Sacramento market?
Yeah, I mean, I'm seeing sellers that are given concessions. You know, probably 50-60% of the contracts that are being written have some sort of seller concession, and I'm trying to lean on realtor partners to say it's more important than ever for us to kind of collaborate and work together as a team on how we want to write the offer, because you know, from a buyer's standpoint, you know, real estate for most people is a long-term investment. They're not trying to buy Dogecoin and see it go up 400% in 3 days. They're going to buy real estate and live in it for a decade or two. And so they just need a payment that fits into their budget. And, you know, as much as it's probably not the reality, people shouldn't like think about what's it going to be worth in 6 months, 12 months, 18 months, 24 months. You don't check it every day. Like you shouldn't check your 401k or stock account every day. You just put money into it. And over time, it's a wealth builder. But, you know, back to that question on what I'm seeing and the timing of it, right? Like there's deals to be had. If I was a buyer, you know, Sacramento specific, the markets that saw crazy appreciation, Sacramento, Boise, Idaho, Phoenix, Arizona, bunch of places in Florida, Vegas, bunch of places in Texas. Those are the ones that it feels like they're frozen right now. And sellers are like a deer in headlights. Like, oh my gosh, my house has been on the market for 17 days and I've only had 4 showings and 0 offers. Like some of them start to freak out. And the subtle freak out is 2 price reductions. If you talk to them, it's crazy how fast it's turned, where it went from, you had to put an offer in within 9 minutes and it got listed on Thursday and in contract by Friday night.
Yeah.
The cool part for buyers is that sellers are saying, bring an offer. My seller will entertain anything and maybe we'll counter, but it's hard for the people that are looking at it and saying, well, if I wait another 3 months, it'll be better. If I wait another 6, it'll be even better than that. If I wait a year, things are going to be 40% off. Not necessarily the case. I think that the pain that's being seen right now, where somebody thought they would sell it right away in mid-August, now they've been on the market for 6 weeks. Traditionally, it's harder to sell a house in the fall. And so as we enter fall and winter, there's going to be a lot of deals to be had. And whether you buy it in October at one rate, or whether you buy it in February, maybe a different rate, but 15,000 less in cost, it really is what fits into your budget over the long term. Because, whether you buy something at 498 or 507, 2 decades from now, you're not going to worry about. You want to worry about your financial position today, what's a comfortable monthly payment, and really when you're ready is the time to buy, not when the market is ready, because nobody, me, Jason, anybody else, nobody knows when are we going to be the exact bottom and the best position with the best interest rate. That's impossible to figure out.
Yeah, I would say just have long-term time horizons. It's so impossible to time the market, and don't listen to anyone who says now's the time now's a good time to buy, right? Classic real estate agent, right? Now's the time to buy, and also now's the time to sell too. By the way, Stanley had this question a couple of times: why Redfin and Zillow not reducing the house estimates? So honestly, like I think what Matt just said, I don't even look at my house estimate because often it's not even right. They're just it's just a computer generated number. They'll give my neighbor the same Zestimate or Redfin estimate if we have the same size house, whether my neighbor's house is totally outdated and mine's super updated. So I never actually look at those estimates. They fluctuate all the time. And also I'm planning on living in my house for a long period of time too. So, short-term fluctuations in value have like no bearing on what I'm going to be doing, my plans. Hamil says, do you think rates will ever go back down to 2%? Rates didn't really get to 2%. They're around like 2.7-ish on average nationwide as of January 2021. And then, or was it 2021. And then also August last year as well was very close. But yeah, I mean, that was kind of it seemed like a once in a lifetime event where everything was stacked up for just incredibly low rates, with the Fed buying mortgage-backed securities, lowering the federal funds rate to 0%. It was just like the perfect storm for very, very low rates. So going back to 2% or 3%, it's going to be a long time before we see that. In my opinion.
I would not hold my breath. I would say there's a better chance you'll never see those rates again than we would. So
yeah, I'm glad I refied. What was it, last August? I got really lucky. All right. Trying to see if there's any more questions here. By the way, we're going to be, this is going to be until 4:00 today. So if you guys have any questions, just put it in bold question, and then we'll answer your questions for you as best we can. Run, can we cancel our new home contract due to rate increase? Will they refund the deposit? So I would say talk to your real estate agent who hopefully represented you. That's number one. Number two, look at your contract, because the contract can state your options of backing out. So I would look at the terms of your contract. One thing I want to note regarding this is that I made a video posted, was it this morning? It was this morning, regarding Lennar's latest quarterly earnings report for third quarter. And it was really interesting because I actually looked at the call transcript, which is like super long, but I gave you kind of the Cliff Notes version of it. But they basically said that in their best performing markets, they're still giving buyers concessions, still giving buyers paying their points to reduce their interest rate, and also in some cases reducing prices as well. But they also mentioned in that report a couple of times where they said that in order to avoid cancellations from home buyers, meaning they have a buyer who's in contract to buy a house, they actually have reduced their asking prices and have given the buyer concessions in order to avoid more cancellations. So that was like, whoa, that's pretty eye-opening, because normally you lock in your price with your home builder, and then the house is built, 6 to 12 months from now, and there really is no wiggle room on the contract. It's set in stone. But builders right now are more willing to work with buyers right now, because a lot of people are backing out of their contracts right now. Lennar's second quarter earnings call was calling for, or actually they reported 11%, or actually it was a 12% cancellation rate. Fast forward 1 quarter later, third quarter, now it's 21%. So they went from 12% down up to 21% right now. So every market's different though, but if you're in contract to buy a new build and rates have increased, and you still can't afford to buy the house according to your lender, then you may want to try to renegotiate your contract. That's my advice for you. Anything you want to add regarding that?
Well, I was going to say, yeah, I've had conversations with buyers that called me and they said, hey, what should I do? With this new rate, I don't know if the payment is comfortable. And, like I tell all folks, like, home ownership shouldn't stress you out. Home ownership shouldn't put you in a position where, you're living paycheck to paycheck and you can't travel and all those other things. And so I told this one that I'm thinking of, give me a call back. Let me know what happens. Let me know what comes of this. Called me back and said, they came down $20,000. They came down $20,000 and were able to give me some credit for a rate, something that fits into my budget. So for sure, like you said, 1 in 5 buyers are canceling. These home builders, with demand down as much as it is, they don't want this stuff to sit, right? It's bad look for them. And so they're going to negotiate. Same holds true for a traditional seller. Traditional sellers, same as a builder, where there's less people on the demand side. They're going to be willing to offer concessions and be willing to negotiate on price. So all good things for buyers.
Yeah, for sure. And Bobby says, big shout out to you, Matt, for helping him buy a house.
Oh, sweet. Where's Bobby at?
Robert P.
Robert P.
We also have the Summerlin. Interest rates were 18% in the 80s, but home costs were not as bloated. Yeah, absolutely. I always love it when someone says, oh, the rates are only at 7%. Like, I remember back in the 80s, rates were like at 18%. Like, this is nothing. It's like, well, yeah. How much were home prices
Sacramento
back then?
for 72,000 too. Yeah.
Yeah, exactly. Right. Yeah, exactly. Yeah. Wages were not aligned. Exactly. Let's see a question here. Question: builders are not just finishing houses and putting them on the market. How long will they hold them on the market before they really start dropping prices? Yeah, it just depends on the market and how many houses they have. I mean, back in the day where you could like walk into a sales office at a new home construction site, the first question I would ask is like, how many houses do you have that are completed, ready to move in? Because you get the best deals on those properties because they have so much holding costs in those houses. I mean, think of all the tradesmen, all the materials that they went into the building that house. They want it sold because they have a lot of money invested already. And so, I think the best deals you'll see, whether you're in Sacramento or any town in USA, is for those houses that are completed. The builders are going to be much more willing to negotiate with you. Anything you want to add regarding that?
No, I'm reading through some of the comments, and it's, the $1 million question is, when do you feel will be a good time to buy? Fall of 2023, everybody wants to point to a time. If you have somebody telling you a specific time in the future when it's going to be the best time to buy, or predicting anything with certainty, that person is full of it. Me and Jason will both say, like, we have no idea. And if I could time the bottom, if I knew exactly what rates were going to do, what housing prices were going to do, what everything was going to do, I'd long been retired, right? You wouldn't see me here. I'd be on a beach somewhere. And so, rather than try to time it, which we've, come to agreement is impossible to do, like, buying a home and home ownership is specific on the person, their financial situation, their ability to buy and their comfort level with, the payment and their finances. Trying to time it is a fool's errand, in my opinion. So I think that, whether you're an investor or you're buying something as a primary residence, you don't. I have investor friends that bought last month and they're buying this month and they're buying the next month after that. They're going to buy January of 23. They're going to buy in April of 23. They're going to buy next fall, and so on and so forth, because just, it's not a market thing. It's a matter of, for some investors, return on investment. And when the rates go to 7.5 on an investment loan, you just change how much you can pay for a property. And a duplex that you could have paid $525 for in January and cash flowed, you can only pay $410 for it now, because the numbers have changed, because the interest rate has.
Totally.
But it's not a, hey, come March 17th, 2024, that's going to be the time.
Yeah. I mean, you think of all the people who panicked and sold in mid 2020 who tried to time the market. It's really challenging to do. I always say, just buy when it's right for you and sell when it's right for you. What do you think about the Phoenix market? I actually made a video about the Phoenix market, including what I do. Was it Boise? I can't remember. If you search my channel, you can see I made a video about Phoenix not too long ago. I'd say it's probably a week or two ago.
I feel like Phoenix is acting a little bit like Sacramento, right?
Yeah.
Had a great run. And,
yeah. I was going to say the interesting markets I'm really drawn to is Miami, because Miami has been holding up pretty well. And then in stark contrast, Phoenix, Boise, Austin, Texas, and then parts of Utah, for example, just seeing like dramatic changes. And it's fun to make these, I don't know, kind of like reaction videos where I'm just looking at the stats in real time and talking about the market, and just remarkable to see the changes. Yeah, and going back to your question here, will home prices go down to pre-COVID level? I mean, some areas like Boise, Idaho, what was it I saw? I just did this math. I think it was like 60% gain compared to 2019. So prices would have to like absolutely plummet for years in order to get to pre-COVID levels. And so some markets where they see a giant increase of home prices over the past few years are not going to see pre-COVID levels for a long time.
Yeah, I mean, it's one of those things where it's like, when will we get that price? You might never, right? Like there's plenty of times in history where it's like, this price was this price here, and while you'd see some ups and downs along the way, like decade over decade, it's hard to find times when real estate gets cheaper.
Yeah, for sure. Peter had a good question. With the Fed buying the bond market, buying mortgage-backed securities, what will stop the increase in rates? I think he means with the changes in the Fed, because the Fed buying it? I don't think they're buying any more mortgage-backed securities, right? They're just looking to try to sell it eventually or get off.
Yeah, they're letting it run off their balance sheet, and they'll likely sell in 2023 as well. So
how will they sell the running off their balance sheet, getting rid of their mortgage-backed securities? They have what, $2 trillion or something like that?
Yeah, and so like as that stuff matures and just falls off the balance sheet, I don't want to get too technical with it. I think the question, like, what will stop the increase in rates? A change in direction from the Fed is really what's going to stop the increase in rates. And as much as like people look at the 10-year Treasury to kind of determine where interest rates are headed, you can also look at inflation. Like inflation and interest rates, there's a strong correlation there. And we know that, as like we've seen inflation run up, interest rates have followed. Once inflation gets under control, there's a lot of smart people that I follow that believe, interest rates will follow inflation down as well, which might be, something for people to look forward to who are looking at a 7% interest rate and kind of, thinking it's impossible. And one thing too, like me and you talked about this a little bit, Jason, for people to consider, and I've got a video on my channel, shout out to Math and Mortgage Guy on YouTube.
No self promotions on the live stream, Matt.
Just check out the channel.
I just,
Um,
lightly subscribe to his channel.
yeah, lightly subscribe. I've got a lot of clients looking into right now, because as rates have gone dramatically up, we talked about less than 8 weeks up 2%. That change in payment is dramatic. And so a 2-1 buy down, I won't spend an hour on this, but a quick minute is, if you're going to pay a point for a 6.5 today, you can do that. But on top of that, you get a subsidy from the seller for a 2-1 buy down, which gives you 4.5% in year one, 5.5%.
Back up. Yeah. What's a 2-1 buy down?
Okay. So your rate is 2% lower in year one. It's 1% lower in year two. And then years 3 through 30, whatever the start rate is your rate for the rest of the loan. And
what do you mean the start rate?
So
you mean the rate we have like today, or you mean the rate at 3 years later from now?
Well, the rate we have today, right?
Got it.
Because
All right.
it's still a 30-year. I guess it's not a 30-year fixed, but I wonder do I have permissions to share?
No, I don't. I don't give you permission to share, because I know you're going to share something that
No.
YouTube's not going to like and see monetize my video.
No, they're not going to care about this. They love this stuff.
What you're saying though is that there's a program out there where you can have a lower rate for the first 3 years, pretty much, and then after the 3 years, then it becomes whatever the current rates are right now.
Yeah, and quick example is, I got somebody buying an $825,000 house with 25% down. Their payment in year one is $41.25, then $45.03, then $49.01. And for those who are scared to death of anything that changes, and would say adjustable rate, well, the 6.5 is today's rate, right? And they're never going to go above that. If they can't refinance, then they're in that 6.5. Some people are just going to get in that 6.5% rate and pay $4,900 a month forever. The way this program works is all that interest savings in the first 2 years is a seller subsidy, and it can only be from the seller. So the seller's got to be willing to give a $14,000 seller credit in subsidy. The buyer saves $776 a month in year one. They save $398 a month in year two, and then $49.01 from years 3 through 30.
So you said it's a $14,000 concession, you said?
In this example.
That was my question. It's based on the loan amount or the purchase price?
It's based on the loan amount and how much, that 2% in year one and 1% in year two interest rate reduction is going to save the buyer. So basically the buyer's saving $14,000 interest, the seller's coming forward and saying, I'm going to pay for this. Yeah. And the cool part about it is, if you refinance in 18 months, because now you can get into a 4.99 fixed or whatever it is, whatever's left of that subsidy is sitting in an escrow account. You get that applied towards principal. So the buyer doesn't lose it. One of the drawbacks of paying points is like, hey, if I pay points today, if I refinance 12 or 18 months from now, that's just
gone.
Sunk cost and it's gone. In this case, you actually get that money back.
So I'm stuttering here. That's a way better loan product, it sounds like, compared to an ARM. Whereas, you have a 5-1 ARM, it's fixed for 5 years, then it's a variable thereafter. And then your rate just fluctuates every year based on current market conditions or current interest rates. And so that seems to be a far less risky loan product than an ARM.
Oh, for sure. I mean, because those ARMs, they might have 6% they can adjust. It might be able to go from 4.5 up to 10.5, and 10.5 would be quite nasty. This one is, today's rate is the highest it's going to go. It's going to be 2% lower in year one. And, I think I saw a comment about, paying points is stupid when you're going to refinance in the future, except for in the case where it's got two things going for you. One, the seller pays it. And two, whatever's left over is sitting in an escrow account and you get that back as the buyer.
Right.
When you refinance, if you refinance.
And that only works in a market where you have more of an advantage over the sellers, where you can get some concessions from the sellers. I mean, this wouldn't work back in the spring where no one was getting concessions in most markets. And now we are seeing that. So that could work in our marketplace right now. And it's always a good time to buy, by the way. I don't know if you guys know all of that.
That must have been a real estate agent in the comments.
No.
Real estate
All right.
mindset isn't going to agree with that.
You know what's funny? I don't watch any other real estate channels at all. I'll only watch Graham Stefan videos when he talks about the housing market. Then meet Kevin sometimes too. But other than that, I'm like tapped out when I'm like researching housing market trends all day, and I don't even watch anyone's videos. No offense to you, Matt. I'm sure they're amazing, man, but I just can't like watch any housing market videos. I just zone out and watch like Stradman and watch him drive around his Lamborghinis and Bugattis and stuff.
Yeah, so I just saw that super chat from Real Estate Mindset. That's why he came to mind.
Oh, really?
But yeah, I mean,
I missed that. Sorry.
It's good. It's good. It's a super chat. He said, "Great work, gentlemen. Thanks for the continued hustle."
Sorry, I'm way behind these comments.
Trying our best.
Yeah. Thanks, Real Estate Mindset, for sure. I'll have to check out his videos. And he pops into these live streams. I appreciate you joining, and thanks for the donation too. But yeah, I don't watch anyone's videos. I probably should. I don't know. I used to go on like Graham Stefan and I'd say, oh, what is he talking about? And I try and make a video and make it try better than his. And now like I just know when like new reports are coming. It's in my calendar, and I don't know.
Yeah, sometimes there's too much. Sometimes you just gotta, check out other stuff. But Graham Stefan had Mr. Beast on. That was an interesting one I checked out today.
I watched that one. Yeah, I watched the iced coffee hour too. It was like an hour long one. Yeah. The only thing he didn't really say like how much he actually makes. He talks about how much money he spends, but not really how much he makes.
I'll give you the answer. It's a lot.
I'm sure it's millions of dollars. He's spending $3 to $5 million a month, and obviously he's making a lot of money. But I think he just puts it back into his channel. Let me get to some comments here because we're going to wrap this up here. Let me see if there's any other questions here. I'm just looking for a bold, and it says question. I don't see any. Let's see. What channels do you follow, Matt, other than real estate channels?
Me?
Yeah.
I watch some UFC stuff.
Oh, do you? Okay.
Yeah. I wonder if you went to my YouTube, because it's always funny, like what they show you based on what you watch. I bet it would be Sacramento Kings, UFC, and Patrick Bet-David, Alex Hormozy. He's a great one. It's funny. I'm just going through my feed. Oh, look, Jason Walter. Holy guacamole.
Hey. Yeah, I posted that with rates increasing so much.
Real Estate Mindset. He showed up on my feed too. So see,
I'll have to check him out.
Maybe when you say stuff out loud, like just like,
yeah,
this stuff works.
Alex plays games. I see a question here. I'm just going through the comments, so I'm a little behind here. Do you think with remote work being less common, will local markets will vary even more as pandemic growth areas slow down and people moving back to the office? Could potentially see that. I'm kind of curious about that too. We've been talking about this for quite some time though, and really haven't seen a whole lot of changes here, I don't think. But the markets that have seen the biggest upticks in our housing market since mid 2020 have been those pandemic hotspots like Sacramento, Austin, Boise, for example, and seeing the biggest slowdowns here too. So
yeah, I always like, just on a side note on that too, I always thought to myself, like, with remote work being more common, with the ability to kind of work, in different places, and then like Silicon Valley specific, because we're both in Northern California, so I think that's close to home for us. With there being other tech hubs built across the country, my thought is like, how can they continue to sell homes for $1.5 million for 1,100 square feet in, San Francisco, Silicon Valley? But for whatever reason, like those home prices tend to hold up pretty well. And I don't have the answer, right, to explain it. You'd think that would start to, level out as people find, new tech hubs, new places that are lower cost of living with similar, type of job opportunity.
Yeah, for sure. I mean, I made a couple of videos about the California housing market, and the markets that have been decreasing the most regarding home prices compared to 1 year ago have been in the Bay Area. I think San Francisco was down like 12% on a year-over-year basis. San Jose seen decreases as well. Oakland, for example. So
maybe it's coming. Maybe I'm just a man ahead of my time when it comes to thinking.
I mean, it's hard to know like what's really going on. Let's see here. All right. Let's see if we can see more questions here.
7% at a cost of 2.35. I hope that's an
all right.
investment.
2.0 sports. I'm going to look at a couple more questions here and we'll wrap this up. What's your advice? We've been renting an apartment for 10 years. We saw a net of $8,300 a month. We save a net of $8,300 a month. Wow. That's a lot of money you're saving each month. Wow. Wife wants to buy a house, but I want us to continue to save. I mean, that's a lot of money you're saving. That's awesome. $8,300
like
a month.
$100,000 a year. Yeah.
That's amazing. I mean, well done on that. Wife wants to buy a house, but wants to continue to save. I mean, gosh, I would look at what your rent is versus what your housing payment would be if you're going to buy. And then, if you're going to be able to buy something similar to what you want to actually live in. So some people who have like very low rent, I don't know if you have very low rent and or super high income, but if you have extremely low market rent, whereas if you were to buy a house and your housing payment would go up like 3 or 4 times, then you may want to save, but it just depends on your situation.
Yeah, you got to also analyze, how much you love your wife. That was my attempt at a joke. I was going to say there's no reasoning when it's like my wife really wants this, right? Like I don't analyze that financially. I just say, okay, honey, when do you want to do that? You thinking about October? All right, let's start over.
That's too funny. Missing out real estate mindset and Sachs Realty or on Flame. I don't know Sachs Realty or Sachs Realty.
I got to connect you with Todd Sachs. He's out in
Sachs.
God, where the heck is he? Is he in Massachusetts? He's somewhere on the East Coast. He does every Tuesday. He goes live, and great dude. Long history in the construction business, and now he owns a real estate brokerage out there. I think now that Tej's World reminded me, I'll do like an email intro or something. You guys could do a collab. Be cool.
Where's he based out of again? You said?
Gosh, I feel like an idiot for not remembering. Is it Virginia?
It's all right. No worries.
Somewhere
not in
on
California.
The East Coast. No, East Coast for sure.
So Timothy said a while back, a comment, you should grow your beard for the housing bear market. We grow the full amount, man. If you correct 30%, oh man, 30% or more national average. That'd be bold. I don't know. I don't think I can do it. It gets
the national average is not going to go down 30%.
Yeah, I would look like Survivor, Tom Hanks in that movie for like years. I think probably if I had to do that.
I know that I can't grow a beard, so I'll grow it. That's how much I believe that we wouldn't see a 30%.
That's too funny. Thanks for Jason. Thanks, appreciate it. Thanks. This video is absolutely bonkers. Appreciate it. I think that means that we're doing a good job. I don't know.
Bonkers.
Bonkers. I think it means good. I don't know.
Good. Yeah. I'll take it as good. Yeah. Perception.
Central Florida market. I actually made a video about the Florida market. What did I include? Tampa, Miami, and I want to say Jacksonville. Made that video 2-3 weeks ago, something like that. So yeah, other than that, I really don't know much about the Central Florida market. And why are jumbo loans lower rates? Matt, the mortgage guy.
In general, they're lower rates because lenders can make
right now. Good.
Lenders. Well, it's a whole different animal. But I mean, I think one quick explanation for it is if I write $100,000 loan and I make 2% commission, that's $2,000, and there's fees and whatever. If somebody writes $1 million loan, they could make 0.5% and make $5,000. And so that $1 million loan, there's less like yield that needs to be made on the origination side, meaning they can charge a lower rate. And besides that, there's plenty of portfolio products where, these jumbo loans are for some financial institutions, they do them at a loss, or they do them and don't make anything, so that they can get, people with high net worths, investment accounts and business accounts and things like that. So, it's a whole different market, but especially on the jumbo arm side, like you can see some really competitively priced 5 and 7-year arms on the jumbo side. Yeah, somebody said Maryland for our buddy Todd.
Oh, that's where he is. Okay.
Yeah.
I was wondering
sorry, Todd.
He's in Maryland,
Been,
right on.
it's been a tough couple of days for me in the mortgage market, so my brain is melting.
So yeah, he's talking about here because look at 7.08 for a 30-year fixed rate mortgage, but for a 30-year jumbo 6.05. So about a point difference there. So that's where his questions I'm guessing is stemming from.
Yeah,
And thanks, Benjamin, for your donation. Really appreciate that. Thanks for your checking out our video today. Anything else I want to add? Anyone else has some last minute questions too? I'll wrap this up and hop off. Join the family here in just a little bit.
Yeah, I mean, I think that, if no more questions, pop through, my advice to folks, I'm not the sun is always shining. It's all butterflies and rainbows, must buy now. But Q4 of 2022, Q1 of 2023, for buyers who are going to occupy, for investors, there's going to be plenty of opportunities. I'm not saying you have to buy. I'm not saying you should be in any rush to buy, but go out there and at least have an understanding of what you're comfortable with, what you qualify for, what that looks like. If you're not comfortable, you don't feel like you're ready to buy a home, then don't. But if you're in it for the long term, I'll continue to preach that whether you pay $530 or $486, if you stay in it for two decades, you're going to win holding real estate long term. And the good news is that when you go out there and you secure, whether it's 6.5 or 5.99 or whatever the interest rate is, the bank agrees that they won't raise that rate on you, and you get locked into a 30-year fixed rate loan. If rates go down, you get to say, you know what, I'd rather pay you 4.5%. And I think I saw a Warren Buffett video recently where he was like, the 30-year fixed rate mortgage is like the most beautiful thing in the world. Like they can't raise it on you, but if times get better and rates come down, you can refinance, which is a renegotiation to say, you know what, bank, I'd rather pay you 4% interest. So anyhow, that's my 2 cents.
That is the beauty of it. I mean, I remember when I used to rent a while ago, and your lease is coming due. You don't know how much they're going to raise it by, and then you're not prepared for that. And just having like some anxiety about that too, with not really knowing how much your housing payment's going to be. Whereas if you buy a house, your housing payment more or less is fixed for 30 years. There's some fluctuations, of course, with insurance and property taxes depending on where you live. But yeah, your housing payment more or less is kind of fixed for 30 years. And so it's a really good combat against inflation here. A couple of quick questions here. Predictions for interest rates December and January, Mr. Matt, the mortgage guy. And also, what is a jumbo?
Predictions for December, January, similar to where they are now. I'm gonna go with that. I'm gonna say that we may go a tad higher, but to go above 7.5, I don't see as very likely. So
if Matt's wrong, he'll buy you a house.
I will. Just give me a ring. Go to greatmortgagebroker.com and fill out the form. I'll buy you a house.
There you go. Yeah. And what is a jumbo loan?
A jumbo loan is based on loan size. For a lot of parts of the country, if you've got a loan amount that's more than $715,000, you're going to be in a jumbo loan. In some of these high cost, Santa Clara, San Francisco, and high cost counties, you can get a conventional loan up to, I think, the new limit, which they're already honoring 2023's limits of like $1,073,000.
Oh wow, it's over $1 million now. It was like just under $1 million before, right?
Yeah, it was like 970, and now it's up like 10.5%. So it's like $1,073,000 on a 1-unit conforming conventional loan. Wow. But yeah, those higher loan amounts are considered jumbo loans. So it's different underwriting guidelines, different down payment requirements and whatnot. But jumbo just means, well, big, right? Like jumbo shrimp.
Higher loan balance. Yeah, absolutely. Jen, thanks for joining. Would love another video on Tacoma, Washington market. We're going to buy for over a year as a first-time home buyer. Yeah, I'll take a look at that. Tacoma, Washington. I think I made a video not too long ago about that. But yeah, thanks for the suggestion. I love your videos. Keep them coming. Military stuff right now. Our housing allowance hasn't followed the market. That's something I haven't followed, or I'm not really too familiar with. But if that's the case, I mean, it's kind of like wages, where wage growth is not even close to being in line with the home price appreciation we're seeing right now. So yeah, I can understand where you're coming from. All right. Think about moving to Houston from Sacramento. Yeah, there's someone I know here in Sacramento who moved to Houston a couple of years ago. No, 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 no. We got Bothell, Washington. I never heard of Bothell, Washington. Can't even pronounce it. I think with that, we'll wrap up this video. Matt, I really appreciate your time. Thanks for joining. I texted Matt, a few hours ago and said, hey, rates are at 6.0% right now. And so I was freaking out. And I want to talk about it because wow, I haven't seen rates at 7% since, it's a 20-year high, right?
Right.
Rates we haven't seen since 2001, or is it 2002-ish, something like that?
Yeah, it's been a long time, and it's having an effect. People talk a lot about how it affects buyers because of their affordability and purchasing power and all that. It affects sellers too. So sellers have to think about this too. If you listed your house for $550, you didn't see a lot of action on it, know that with these rate increases, less buyers are able to qualify. And on top of that, they've got to be not only able to buy, but willing to buy. And some just say, what, $3,800 payment's not for me. They've either got to give concessions to buy down the rate, or they've got to lower the price, or in some cases both. So it's going to be an interesting winter for sellers on what they can expect price wise to get for their home, and opportunities for buyers. Looking forward to it.
Yeah, absolutely. I've been talking about this for a while, where we have seasonality of our housing market, where now until the end of January-ish, it's going to be slow, because that's just normally how it is. But with the rates at 7%, if they sustain these levels or even go higher, then wow, it's going to be a especially cold winter. We'll see.
Yeah, I mean, that's the truth.
It's
going to be. Yeah, that's the truth. And so the buyers that do want to buy, they're going to have quite a bit of leverage. It's going to be good.
For sure. Absolutely. Well, Matt, thanks again. For everyone who doesn't follow Matt on his YouTube channel, check him out. Matt, the mortgage guy. A lot of good information there. And Matt, I appreciate your time. And thank you everyone for watching as well. Gosh, we had, I think, up to 700 people watching at one point in time during the video here. So I really appreciate you guys joining us today. Yeah. Hope you guys have an awesome day, and we'll look forward to seeing you on the next video.